The market's at record highs, and the forecasts are calling for more.
We've already hit 12 all-time highs here in 2025, and I think we're going to hit a lot more before the end of the year. You know, I started out this year with my price target on the S&P 500 at 6,900, revisited that in early March and reiterated that again, and I remember being laughed at a little bit, but that's okay. And I still maintain 6,900 on the S&P by year end.
That's Brett Ewing, Chief Market Strategist at First Franklin Financial Services. And yeah, he thinks the market has more room to run. Moreover, as tariff policies become clear and deregulation starts to take shape, he thinks it's more green lights ahead and that this rally will carry beyond 2025. He's our big interview. But up first, we're talking healthcare and biotech investing with Jason Akis of Aberdeen Investments. He'll explain why the sector has been lagging while the market has been reaching those highs, but why he thinks that story could be changing. Plus, Brian O'Connor, personal finance journalist, talks about his New York Times piece on how Americans spend their lives saving for retirement, but have no plan for cashing out and managing their assets without running out of money.
Come on, it'll be fun.
Well, I don't know that it sounds like that much fun when we talk about people potentially running out of money and having no plan, but the show will be fun. This is Money Life for July the 25th. Thank you so much for joining me. My name is Chuck Jaffe, and we have a great show planned and executed for you today. A show that covers a lot of ground, gives you some basic market stuff, gives you a little bit of a sector look, and then the Brian O'Connor piece is an important one because, frankly, it's a big deal that people spend their entire life and have no plan. And in fact, it's not just they have no plan and that might make them more susceptible to running out of money. I think in some cases it works the other way. You know, you've heard me discuss since February and the death of Rich in Orchard Beach, Maryland, who was a big fan of the show and had become my daily pen pal over everything that we did, that Rich struggled to get to where he could spend money, even though he knew he was set for life. That's what we were talking about with The Wealth Ladder and Nick Majuli. By the way, that book, one of two that we talked about on the show this week, contests going on. Make sure you get in on those. By the way, the contest was tied to South Park, as you'll find out again when Rob Floyd resets it at the end of the show today. If you didn't see South Park's season opening episode this week, well, there's a reason why it created a lot of buzz. So you might want to check that out too. But that's a totally separate issue. I've said, and again, I can't thank you enough for being here and being active participants, but one of the things about Rich was that when Rich passed, Gail and I had these important discussions, and we're still having them. And they are shaping some of our decisions on what we're going to do and how we're going to do some things, because we want to have a plan. We have recognized that collectively, getting together basically meant that Gail shouldn't have any more worries and I shouldn't have any more worries and what have you when it comes to our finances. Not that we really had them necessarily before. I think Gail had maybe more than I do because she's less into like, wow, I have great control over my finances and I know everything that's going on. But separately from that, that side that says, okay, I've got it, but can I spend it? Again, go back to that Nick Majuli interview where he's talking about how much people can afford and how they don't necessarily think they can afford it. And then you get Brian today talking about how, you spend your life amassing it, but you have no plan for how to cash out. And it's important, mind you, then you get people who say, okay, well, let's try to do this in ways that minimize taxes. And that's great, but you still have to figure out how you're going to minimize taxes. And oh, by the way, you're going to pay taxes one way or the other. I had somebody go back to Rich in Orchard Beach. Rich had done some Roth IRA conversions, converting some stuff to Roth IRAs and paid some taxes, right? Certainly not the worst thing in the world, but had he known what his future was, he might not have paid the taxes then. He might have allowed it to be something that, was handled as part of his estate. I don't know. I mean, we don't get that end date. Doesn't come with any sort of guarantee. So you got to plan and then do what you think is going to be right. Just make sure you can afford it, but you want to do that planning. It has been a market week where the market has driven higher. There's a lot of interesting stuff. We don't normally talk about meme stocks, but I think we may have to talk a little bit about what is going on with meme stocks right now, because we're now getting some meme stock drama again, getting things like Open Door and Krispy Kreme and Kohl's. To me, doesn't feel like a meme stock, but you're not getting the same squeeze that you had when GameStop was making headlines back in 2021. There are some reasons for that, and it makes things a little calmer, but I don't know that it makes things where anybody would say, okay, let's do a meme thing, etc. Let's go after the meme stocks. And I know it's not really the profile of the Money Life listener to do the meme stock thing, but if it's a story affecting the market, we want to talk about it. And if you have things you wish we would talk about, if you wish we do more like the Brian O'Connor interview or more with the stuff that's on the headlines, or you've got suggestions, got picks for quick and dirty and more, send them. Chuck at moneylifeshow.com. Do it this week and enter the contest. That'd be good too. Right now, let's get you off to the talk, because we've got a great lineup. Again, it's Jason Akis of Aberdeen, Brian O'Connor talking retirement withdrawals, and Brett Ewing of First Franklin Financial. We'll kick things off talking healthcare on The Navigator when we really get rolling in 20 seconds.
To navigate today's complex market, investors need accessible, quality research. Vetify offers free webcasts from portfolio experts and industry leaders. Earn CE credits and take your portfolio to the next level. Go to etftrends.com/webcasts and learn more.
Jason Akis, head of healthcare investing for Aberdeen, is here. We're talking about valuations, regulatory policy, and more in the healthcare space. And this is The Navigator. Welcome to The Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, a unique industry organization representing the full spectrum of the closed-end fund business, from investors and users to fund sponsors and creators. If you're looking for excellence beyond indexing, The Navigator will point you in the right direction. And today we're looking in the direction of healthcare investing with Jason Akis, head of healthcare investing for Aberdeen Investments, which has taken back the E's in its name, right? You might remember Jason when he last talked to us was with ABRDN. Well, going back to their full name, it's Aberdeen Investments, and you can learn more about the firm at aberdeeninvestments.com. If you want to learn more about closed-end funds, interval funds, and business development companies generally, go to aicalliance.org, the website for the Active Investment Company Alliance. Jason Akis, welcome back to The Navigator.
Hey, Chuck. It's great to see you again, and thanks for having me back. Really appreciate it.
Let's start with an overview of where things are right now, because we've got a market that's gotten back to record highs, but we've got a lot of overarching headline risks. So what is the environment right now when it comes to healthcare and biotech?
Yeah, it's I think a great place to start the conversation. And before we dive in, I just want to note that some of what I may say today will include probably forward-looking statements, and the typical these statements are subject to risk and uncertainty, and those aren't necessarily of Aberdeen or its affiliates. But with that being said, yeah, it's been kind of a crazy environment in healthcare and biotech investing in 2025. I think, as you noted, broader equity markets are at records. S&P, NASDAQ, they're definitely been doing well in 2025. But I gotta unfortunately say that it's been a little more rocky in the healthcare environment the last several months, and actually probably the last few years. I think over the last 20 plus years that I've been professionally investing in healthcare, I think, it certainly feels like this has been one of the most challenging, difficult, and dislocated environments I've seen. When you kind of look at healthcare is made up of a dozen or so subsectors. And when we've seen one subsector falter, we've usually seen another one kind of pick up the slack. And in 2025, almost everything has certainly felt like it's been under pressure simultaneously, making it a really challenging investing environment. I'd even note the reliable managed care group, companies like United Healthcare, Humana, Molina, really has been a total minefield.
Yeah. Is there something specific that's creating that? I mean, is that just general market conditions making it the valuations are out of whack? Or is it something structural or something in the industry? Because it's not like healthcare is the business we would say, oh, we expect that to really be hit by, say, tariffs.
Yeah, certainly that particular subsector within healthcare, it's all US domiciled, so there's certainly no issues with tariffs. But given the change in, the administration and with more recently the passing of the big beautiful bill and the discussions around, the cuts in Medicaid and potentially larger amounts of the Medicaid population kind of coming off, whether that's from the immigration standpoint or just generally cuts, that's really kind of put a lot of uncertainty on kind of the forward guidance on companies that have a lot of exposure to Medicaid. Another thing that's been going on in the background, and it's not exactly fully clear to me why it's been happening, but healthcare utilization has been rather elevated, at least relative to what these companies were modeling. This could be a side effect. It seems like COVID's ancient memory now, but I think a lot of healthcare services were put off, whether it's surgeries, procedures, during that period of time, and that's kind of come back. And the actuarial modeling, I think, was off. So this has led to a lot of these companies guiding down guidance, at least for the near term. And so when you put all these things together, it really has been a really challenging environment for the managed care group. United Healthcare, I think, has been probably one of the best performing stocks, certainly in the S&P 500. If you look over the last 20, 30 years, it's been amazing. I don't think they've missed earnings in like the last 20 years or so. And come 2025, it started with, the unfortunate assassination of their CEO in New York City, if you remember. And then from there, it's just kind of been really rough sledding. So, but we try to manage it. And I think longer term, I think dislocations ultimately create opportunities, and I don't really see a long-term change to how healthcare gets delivered in the United States, at least for the foreseeable future. And I think, this noise will settle, and I think, like most things, there'll ultimately be opportunity.
In that opportunity, is there a benefit to pursuing it in closed end funds? Is there a bit for you of an advantage as a manager to be working with the closed end structure?
Yeah, absolutely. I think within healthcare, it's really great to be managing. We manage at Aberdeen for, healthcare closed-end funds. And the beauty of the closed-end fund wrapper is that in some ways, it's permanent capital. So it kind of allows us to lean into volatility when the markets are expressing a lot of volatility and dislocation. And we don't have to worry about those forced redemptions that open-ended funds or ETFs may see in those type of environments. So, as we were just discussing, it's been a pretty challenging environment in healthcare and in biotech in particular. So when we get these kind of brutal sell-offs, whether you get announcements that leadership is changing in the FDA, and with MAHA, Make America Healthy movement, and vaccine skepticism, you can get these sell-offs, but those end up being buying opportunities for us because I think we have a good understanding of the companies in our universe, and we can take a longer term investment horizon. And I think the closed end fund structure really does give us an advantage over other fund structures. Another thing that our funds have done historically, in particular our HQH and HQL fund, they have fairly significant exposures in pre-public venture stage, biotech companies. And so venture investments are obviously illiquid, and kind of given what's been going on in healthcare, it's been good for valuations. We've seen valuations come down across the board, but also in the venture side, pre-public. And the closed-end fund wrapper does allow us to kind of invest in this space for the long term, once again, without having to worry about really the liquidity components of the mark-to-market day-to-day issues.
Let's talk just a little bit about valuations. The market is back towards record highs. Does that make it significantly harder for you to find anything that's worth buying? Or is it not a problem because there's enough choice and there's enough innovation and enough new stuff happening?
Yeah, I think there really is a huge valuation disconnect from healthcare and biotech, pharmaceuticals to the broader market. I'm sure most of your listeners would know that the AI trade, the Mag 7 trade, the technology trade has really, I think, driven a lot of the broader equities to these records. When you compare that to healthcare, if we kind of look at broad measure of healthcare year to date, the S&P 1500 healthcare index, as of the close last night, the total return of that is 0%. So we're kind of flat on the year. Biotech's been a little bit better, up maybe about 3%, and that compares to the S&P 500 up 9%. You say, well, that's not that crazy. But if we look at healthcare, let's say over the last 2 years, the total return of healthcare is once again basically flat, while the S&P 500 is up 40%. So it's not to say that healthcare is not growing earnings or not kind of doing what they've been doing. It's just been left behind, I think, just kind of on this FOMO trade with more attractive growth sectors. And so I think this valuation disconnect certainly, I think healthcare is full of opportunities in terms of longer term stock appreciations. And in biotech, it certainly has been a challenging environment, especially post COVID. All these biotech companies went crazy. We saw companies like Moderna trading, bigger than Bristol Myers, multiple hundreds of $1 billion market caps. I think a lot of that wind has finally come out of the sails, or the balloons deflated, however you want to describe it. And when you look in biotech, there are so many companies now trading at negative enterprise values, which basically means that they have more cash than their market cap. Now, granted, these companies, they don't have products on the market, they don't make revenues, and these pre-commercial biotechs just burn cash to develop drugs. But that being said, there are a lot of very interesting ideas, a lot of innovation in here. And I think for the active investor who's willing to put the time in to understand the fundamentals and risk reward, there's just potentially so many wonderful long-term ideas. And we saw something yesterday where a French biotech company that has shares listed here in the US, they announced some phase 3 data in a trial for IBD, inflammatory bowel disease, specifically in ulcerative colitis, that was really actually quite amazing. And what's even more special about what they announced was that this is an oral therapy in a market that's traditionally been subcutaneous or an injectable market. The stock was up 500-600%. They probably went from pretty close to almost having no enterprise value a month or two ago, and now it's trading at multiple billions. So had this failed, the stock would probably be, basically zero. But, that's kind of the environment biotech investing, at least at these levels, that, there's certainly a lot of downside risk, but the reward can be great if you are willing to put the time and understand the risk reward.
One of the other things about putting that time in is that biotech, particularly, is an area where there's a lot of venture investing and venture opportunities. How much is that impacting what you're doing right now?
I mean, it's always been a part of our funds and our investment process. As I was describing, two of our funds have a very long history of doing venture investing. Our oldest fund, HQH, IPO'd all the way back in, I want to say 1987, 1988. And it was specifically created at the time to allow a retail investor to get exposure to venture investments. And, once again, it's the benefit of a closed-end fund structure to allow you to do that. You don't need to be an accredited investor and have tons of money to get that exposure. But that being said, it's something we're always looking at. We're always making investments in. And kind of back to that 2025 challenging environment, we've seen valuations in the venture space actually come in. I think given all the volatility, whether it's with the tariff announcements, the market volatility creating opportunities, we've seen a lot of the traditional venture investors in healthcare biotech actually back off and valuations have come down. And I think over my 20 plus, getting close to 25 years of investing, is I think you got to just keep investing full cycle, even though the environment looks challenging and things could be potentially scary. Those are actually the best opportunities to actually have some pretty significant long-term gains. And so we keep at it, and hopefully the market gets better and capital market windows open and will allow for some exits. But it's just a matter of time. I don't know if that's 3 months, 6 months to 5 years, but I'm certain it will happen again.
Speaking of time quickly, because we're almost out of time, if I have to ask you for a market outlook, I mean, I know we started this with you talking about, hey, you might be making forward-looking statements and they're your opinion, et cetera, but the next 6 to 12 months, are you expecting healthcare and biotech in general to do better than the broad market, or is it going to be tough sledding here?
I may sound like a broken record for people who've heard me speak elsewhere, and I keep saying healthcare is going to outperform. And so I haven't been exactly right on that. But I really do believe, the more that this healthcare broader market disconnects goes on, I really do think healthcare should really outperform the broader market. I encourage everyone just to kind of look at these relative performance of healthcare, biotech versus the broader market. And there's just so many opportunities. And if the US does go into a recession or there's, some type of macro dislocation, I really do think we'll see market participants go back into healthcare and give us relative outperformance. But on a long-term basis, on an absolute basis, I think we're going to see positive returns. And I just always go back to that long-term view that healthcare has just such tremendous tailwinds. We have the aging demographics here in the US, globally, population aging, innovation, it's always there. Companies are innovating, looking for better solutions to the delivery of healthcare, from drugs to healthcare services. And so it's a great time to be investing and not to be optimistic, but just even the last week or two with some of this positive news, pick up in M&A, I guess we're in Q2 earnings, they've been these announcements, despite fundamentals being a little bleak, we've seen actually good stock performance post earning announcements. So I think we have some, I hate the term green shoots, but I think we're seeing them.
Jason, great stuff. I appreciate the time. Thanks so much for joining me on The Navigator. We'll get an update on healthcare from you again down the line.
Awesome. Thank you so much for having me again.
Jason Akis is the head of healthcare investing for Aberdeen Investments. Learn more about the firm and its funds at aberdeeninvestments.com. And by the way, at that website, they've got a great closed-end fund center for all of the stuff they do on closed-end funds. Up next on the July 25th Money Life, I'm talking with my friend Brian O'Connor, a personal finance journalist, about his recent New York Times story on how to properly spend down your retirement accounts. Then it's Brett Ewing of First Franklin Financial for the big interview. Oh, yeah. Welcome back to Money Life, where that sound means we're going off the news. And I'm excited to do it today because I'm joined right now by Brian O'Connor. He and I have known each other for a long time. He is a veteran personal finance journalist, and he writes all over the place. But he wrote a piece recently in the July 12th New York Times that really caught my eye, and I hope is going to catch yours as well, because he wrote a piece that headlined, "You saved and saved for retirement. Now you need a plan to cash out." And it talked about how basically people enter retirement without any idea how to manage withdrawals and how to do it without running out of money. And oh, by the way, as you've heard me say on this show many times, one of the things that winds up happening is that people become so afraid of running out of money that they wind up spending next to nothing. And then they have golden years that are maybe at best bronze or pewter. Like they're not all that good. And you don't want to have that happen either. It is a really good read for anybody who is at my age, which is similar to Brian's, I think, but in that pre-retirement stage, trying to figure out how they're going to deal with sequence of return risk and the rest. It's worth checking out. We have a direct link in our show notes and on our guest page where you find Brian O'Connor. Brian O'Connor, welcome to Money Life.
Glad to be here. Thanks for having me on, Chuck.
Like I said, I think this is an important story, and it's one that doesn't get told because it's kind of assumed you made the money, you're going to know what to do with it. And it's really not that easy, is it?
No. I mean, it makes a lot of sense because, you spend 35, 40 years totally focused on, accumulation, just getting as much money into that and getting good returns on your 401k, your IRA, whatever you're saving for retirement. And then all you really know about it during that time is that you see the ads on the golf tournaments that shows, retirees going on cruises and, having wonderful days at the beach. And when you get to retirement, then you're looking at things like taxes, required withdrawals, social security strategies, and of course, market volatility, economic volatility, and trying to figure out how to create that paycheck is really a challenge. And it's even more of a challenge because at a certain point, you don't get any kind of do-over. If you retire at 67 and you think things are going to be a little tight, you might be able to go back to work part-time, full-time, whatever you need to do. But when you get into your late 70s, if you blew it, your options are Walmart greeter and probably nothing else. The reason for the story was I saw a survey that showed that 49% of Americans who were drawing down retirement assets didn't have any kind of plan. And then of the people who said they had a plan, only 22% of them actually followed their plan. So it was really a surprise. And the financial planners call it decumulation, which is like the least sexy thing to pitch to a New York Times editor. But it's really about, everybody's basic fear in retirement is, will I be okay?
Right. Well, I think there's two basic fears. One is running out of money. That's the one that everyone talks about. The other is being forced to go back to work, the one that you just talked about. And I know that they say that it's like 10 to 15% of retirees go back to work for financial reasons, not because they're bored or not because they want to do something or they love their job and, want to extend it, but because I don't have a choice. And the problem is that if you get to the point where you're retiring and that's happening to you, that's the rest of your life. You're not getting some job that's going to make it, oh my goodness, I'm now on easy street for the rest of this.
Right. There's going to be very few people who can get the $500 an hour consulting gig because they're the guy who has the secret recipe. What a statistic that I have in the story that was interesting to me, that it correlates the 65 and over workforce. When the stock market goes up, the people retirement age and older who are working goes down. When the stock market goes down, the number of retirement age people working goes up. So it's very much showing you that there's a real correlation between the market drops and people have to go back to work, which is your finances get really set when you retire. So it's hard to hit the pause button on something like Social Security. and it's very complicated to unretire, so that you might be able to bring the money in, but it's going to be a real hassle. And then, as you were saying, at a certain point, you just can't get hired, or not for anything that's going to pay you more than bagging groceries.
Well, for me, I say all the time, because one of my hobby gigs is that I officiate lacrosse games, and I'm always stunned at the number of partners working high school games who are in their 70s, and they're doing it for love of the game and to get out and get running. But at the same time, I would hate to be doing it. Like, I look at that and go, yeah, I'm not sure I'm going to want to hurt that much when I get to that age. So I'm not seeing myself do it. I am seeing myself worrying about sequence of return risk. And that's a huge part of this as well, because people can't decide. Like, if we're going to have a market crash in a couple of years, I want to have it right now, like, before I retire and not afterwards. When you were talking to the advisors that you talked to for the story, how much did they say you can prep for sequence of return risk? Because that's a question I get asked all the time.
I think part of it is you have to have your diversification strategy set up. So it depends on how much money you want to keep in cash and cash equivalents. If you had 2 years of living expenses in relatively stable investments at the beginning of the pandemic, then you didn't have to worry too much about your stocks. So that is one strategy that's an old strategy that used to be called the bucket strategy. And that's kind of fallen out of favor because it was a little oversimplified in terms of taxes and other things. So that was a very real thing because people don't know. I lost 20% last year. I lost 30% last year. I'm down 50%. If I have a couple of good years in the market, I can get 50% back. But no, you need a lot more than 50% to make up for a 50% loss. So, 3 bad years at the beginning of retirement, if you have to be taking that money out, can really set you up for a disaster. Or really, it's going to just hurt everything. So you really don't want to be taking out that invested stock money if you can. The one thing that everybody stressed was, first off, you're going to have to make a budget, as horrible as that sounds. And I know many financial planners who really don't have a strict budget, but you want to find out what are my living expenses? What's my lifestyle going to be? Am I going to keep the big barn so all the kids can come home at Christmas, or am I going to get a condo someplace? What's my nut going to be? Gas, groceries, rent, mortgage, insurance, all that stuff. And then you want to cover that with safe sources. So people are looking at Social Security, they're looking at a pension if you still get one. My wife and I both get tiny pensions because our pension plans were phased out early in our careers. Some people are buying simple annuities, deferred or immediate, not the crazy bells and whistles kinds of things. So they're stabilizing as much of their income to cover their basic cost of living. Then they can sort of manage their withdrawals from any tax deferred or taxable investment plans, either to just take out a bare minimum to fill any gap, and then stay that way if markets are down, spend a little more, take the grandkids to Disney when the markets are up, and basically pay attention to all that stuff without having to really panic that they're going to run out of money. So it's kind of stable income sources, slowly transferring out of the market into cash equivalents, a money market fund, a money market account, a high yield savings account of some kind before you really need that money. So for instance, you might start drawing down next year's living expenses by maybe taking a quarterly distribution from an IRA so that you can kind of dollar cost average out. So you're not going making one big $60,000 withdrawal in December if the markets happen to be down, because that's where you hit that sequence of returns risk. But if you're taking it out, before the pandemic, things were great. If you'd taken out half of your living expenses for the next year, it wouldn't have hurt you at all. The other thing is people also have to figure out if they're going to be subject to RMDs.
Right. There's a lot there. And the good news is that the story really helps people kind of go, okay, let me frame it and go have the questions, because you can't answer them for everybody. And even the discussions you have of things like the 4% rule, which has changed and morphed over the years, and which I've always thought, the problem there is that you convince people that you're going to follow this portfolio thing. And what it'll mean is that when they're 90 or 100, they still have the same nest egg. Well, that's really good for the financial planning industry, but most people would be just fine if they knew I could reach the end of my days, cover everything, and maybe leave a little something. But it's not so much about, oh, hold it, let's do what's good for the advisor. And I think for a lot of people, they feel like they got to save to that 4% rule level, and that makes it more daunting. So great stuff,
The back of
Brian.
the envelope thing, the 4% rule is absolutely fine when you're kind of just, doing a back of the envelope, quick calculation, how much would I be able to take out? But the real problem with the 4% rule is that it's like your expenses are never going to change, your returns are never going to change, the economy is never going to change. This stuff all started happening. You have to remember when people were retiring in the 60s and 70s, basically our grandparents, the average man lived about 8 years in retirement, and then his widow, maybe another 5. Of course, my grandfather had a lifelong pension from Michigan Bell that would have covered him till he was 150 years old. But now we have the great combination of a do-it-yourself retirement investing, and then we're looking at 30, 35-year retirements. So a lot of the assumptions that people make about retirement are what you saw your folks and your grandparents did. That is not a good idea.
It is not. It is not. Brian, great stuff. I appreciate you taking the time to join me. Thanks so much for joining me on Money Life.
Appreciate it, and keep up the good work, man.
That's Brian O'Connor. He's a veteran personal finance journalist. Again, the story that we're talking about is one that ran in the New York Times. It is, you saved and saved for retirement. Now you need a plan to cash out. We've got it linked up in our show notes and on our guest page. And if you're trying to figure out how you're going to do this and you want to figure out what those issues are, this is a great primer for you. But we do a lot more than primers here on Money Life, and we've got more to go. So settle back and relax. We'll be right back in just a moment.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at Vetify.com.
Welcome to the big interview on the July 25th edition of Money Life. Returning to the show today, Brett Ewing. He is Chief Market Strategist at First Franklin Financial Services. If you want to learn more about him and the firm, First Franklin FS for financial services, firstfranklinfs.com. Brett Ewing, it's great to have you back on Money Life.
Chuck, I'm glad to be here. Thanks for having me.
I want to start with your take on where things are right now, because, of course, we've had lots of headline risk, lots of volatility. But actually, if you just kind of take a look, we've had a benign path back to record highs. Like if you just kind of focus only on the big picture. So if we stay focused on the big picture, like, are we closer to the end of this rally, or are we closer to, continuing to make new highs and maybe set some sort of a new record or 7,000, something along those lines?
Well, Chuck, that's a great question. We've already hit 12 all-time highs here in 2025. And I think we're going to hit a lot more before the end of the year. I started out this year with my price target on the S&P 500 at 6,900, revisited that in early March and reiterated that again. And I remember being laughed at a little bit, but that's okay. And I still maintain 6,900 on the S&P by year end.
The journey has been one that we have not expected, and expectations do factor into what the market does. But the market, for example, is still thinking that we're going to get 2 or 3 rate cuts this year. Can we get 6,900, which is not that far away from where we're at, but can we get there and hold that if we don't see rate cuts, if we don't see some of the things that people have been expecting all year?
Yeah, I do think it's possible. I think earnings are going to drive this market. We already have really good earnings coming out here in this quarter, surprising to the upside. and I do think that can continue. We have the big beautiful tax bill that went through. I think that's going to drive a lot of capex spending out there, especially in the small mid cap arena. I think it's green light from here. I think a lot of the policies that are in place, whether it's deregulation or the tax bill, that the fruits of that will show up later in the year.
Let's talk for a second about deregulation. When you say the fruits of that will show up, is deregulation something that you think will kind of have an overarching effect and broadly go, okay, this will just be a nice little tailwind? Or is deregulation to you an investment play? In other words, are you looking at this that deregulation is going to make certain industries or certain companies have a significant boost, and therefore I want to invest with an eye towards who benefits from deregulation more than maybe people are investing with like who doesn't get crushed by tariffs?
It does come into play the way the latter part of what you said. I do believe that they are basically green lighting some industries. Most recently, the AI as of yesterday, right? So I think that they want money to flow into certain areas of the economy. And by lowering new regulations or stopping all new regulations and unwinding some existing regulations to make the path for investment easier and shorter time frames, that is what I think is going to come out of this. And that is going to spur investment into different parts of our economy. And that's why I was saying earlier, the fruits of that will start showing up by year end. It's already happening. And I think that it's going to play into a very nice setup for 2026.
A very nice setup for 2026. Obviously, that sounds like we're able to keep going, avoid the headline risks, et cetera. So let's talk about how we get that set up. How many rate cuts are you expecting? Are you thinking the tariff certainty that we're going to get once we have that, that the market can keep going? Or as much as you think we're getting 6,900, I mean, the route to where we've gotten now included a big decline early this year. How smooth is this sailing?
Look, this rally is certainly pretty historical, actually. We're hitting, I think today will be 62 days above the 20-day moving average. There's only 8 other times where it's gone this long since 1950, I think was the stat. I think that's some very bullish signs in the short term. In the last week and a half, I see a little breakdown with the breadth of the market, but I think that's to be expected considering the move we've had off the lows in April. I do believe that 5-10% correction is very normal, and I would expect that between now and the end of the year. But I do believe that it's likely to be a pretty smooth path. I mean, look, this is one of the best business environments. And you're talking about the Fed. Yes, that is a tailwind to the economy. And I do believe the Fed will cut at least 2 times this year, possibly even three if the inflation numbers continue to stay muted, which they have the last few months. I believe three could happen, but it's likely just to have two. But if you combine that with deregulation, right, and you combine it with an incredible tax bill that just was signed off on, I believe that you have one of the best economic environments for businesses that I've seen in probably the last 28 years.
You talk about being above the 20-day moving average. Of late, we've also had a big run that was days where we didn't have a 1% move, where for as much as people have been expecting volatility, we had, I think we just broke it this week actually, where the S&P finally had a day where it moved 1% for a day, but it had gone like 18 or 19 days. There are some that would say if you don't have much movement, then you're losing momentum, but it does make things seem pretty benign. For you, if volatility is what most people perceive as risk, and they do, how much do you have to convince people to not be too excited? Because if we're making new highs and we're doing it without much volatility, that's when folks get irrationally exuberant.
Yes, I mean, I deal with that professionally every year, and it goes both ways, right? Too much fear, too much greed going on. And I will tell you that I have had many people believe that it's just endless and they want to dial up their risk at this point in time. And it's a conversation about, look, you always respect risk. It's always going to be there. This can change on a dime. There's no doubt about it. We've seen that happen. And you always have to manage based off your personal risk and not just change it because you feel good about what's on TV or how you feel that month. That's a recipe for disaster in personal financial management.
One of the things that happened when you and I spoke a couple of times last year, at the time, you were thinking we're going to see more of a broadening of the market. We're going to get to where small caps finally get their day. We've seen some breath in the market, but we haven't seen a small cap rally. Is one finally coming? Like, we've done this without that much of a small cap rally in a market that's supposed to be earnings driven, et cetera. We would expect that we're going to wind up seeing more. Is that rally finally coming, or is that rally just going to be, yeah, it's a little bit better, but it's not actually a rally?
Yeah, you're absolutely right, Chuck. I am big on the small and mid cap arena, and we did talk about that last year. We did have after the election, you saw the Russell did break out and was one of the leading indices out there until we get into 2025, and then that obviously fizzled going into April, and it still hasn't hit back at that new high, whereas the other indices have completely done that. But I do feel that having this particular tax bill that's been put in place is actually more beneficial to smaller companies than it is the larger companies. And I think that they will take advantage of that. By them taking advantage of that, again, I mentioned the CapEx spending. I think that is the part of the economy which is the largest employer throughout our economy, small businesses. But their CapEx spending, I expect it to explode going into the end of this year and into next year with the tax benefits that they're going to get. And I think that the small mid cap indices, yes, it's been tough to be in that area of the market. It's been very frustrating, but they have the platform now. They have low regulation, which they perform better in historically. They also have the great tax situation going on. And now they're the ones who use capital, right? They borrow funds to help fuel their growth more than, let's say, larger mega caps do. And that's important. So now we also have a tailwind with the Federal Reserve set up to be lowering the cost of capital as we move forward here through 2026.
What's your take on domestic versus international? I mean, we've got this market that's doing well, but we've had great results internationally. Is that rally going to continue, or is that rally what we've seen and not much more?
That is a great question. And internally, we debate that on a weekly basis with me and my research team. I'll tell you what's interesting about 2025, Chuck. Our Fed has been at a pause, right? Well, the rest of the world has been cutting. In fact, there's been about 64 rate cuts around the globe this year, and that's with 30 different countries. And so we're the only ones not cutting rates around the globe. Now, when the other feds are cutting and we're not, that is a very attractive environment on a relative basis. And I think money flow has been flowing into developed international primarily because of the cycle that they're in. And we all know when the Fed starts cutting, that is a lift for many different asset classes. And I think that the markets are taking advantage of that situation. It's very rare. Typically, throughout history, it's our Fed that takes lead on how rates move. We've just had a very not normal situation going on in 2025. In fact, just to put this in perspective, we've had the most rate cuts around the globe in 2025, the most since 2020, to put that in perspective.
Wow. Are there sectors and areas of the market that particularly appeal to you right now?
Well, I believe that the industrials are going to do very well through the end of the year. We also like, as far as an asset class, the small and mid cap arena from a value standpoint. It's at historical relative low values compared to large cap, especially when we get into just, the tech area. We like technology as well, though. but we're kind of cherry picking down into the mid cap and small cap arena. That's what we've done this year. And it's really starting to pay off within the tech sector. And that's probably our strongest area that we're focused on.
Given everything that's been going on with the market getting to record highs, the interesting thing has been that the bond market is doing great. Bond funds are fabulous. You're getting great returns out of the bond market, and you can clip a pretty nice coupon. And yet investors are not interested. How much are you struggling to keep people interested in the fixed income side of things at a time when it's tough to get your eyes off the market at record highs?
Yeah, definitely. We have comments about should we move more money, allocate more money towards equities in this environment away from bonds. And we always like to go back and think through the last few years, right, Chuck? Asset allocation, we all remember 2022, asset allocation did not work, right? Bonds went down just as much as the equities did in that particular year. And we are back to asset allocation models actually working. This is a great year as an example. You mentioned the bonds are up. Yes, they're doing very well, especially in the emerging market arena and in convertibles, which we have kind of skewed our fixed income towards that. We did that earlier in the year, and those are performing great. And that's helping out a lot with those conversations. Another area within the fixed income that we like and have still quite a bit of exposure, obviously, is treasuries. And we believe that the yield curve as a whole, these yields are going to be going down over the next year and a half.
From that perspective, is the advice to most folks, hey, given what we've seen happen, how it's all playing out, it's a good time to rebalance, a good time to kind of sit tight? Or is it, at this point, given that you think the market can go higher, keep in mind that any market dip is a buying opportunity?
I would tell your listeners out there that when they see dips in this market, they should take advantage of them. Does that mean they have to completely change their asset allocation? No, but if they're sitting on dry powder, I would put it to work on any dips in this market. I think it's a great setup for the next couple of years with the policies in place, the taxes in place, and don't forget the Fed cutting rates over the next year, which I do believe will happen.
Brett, great stuff. I appreciate you taking the time to join me. Thanks so much. We'll do this again down the line.
Hey, thanks, Chuck. Thanks for having me.
That's Brett Ewing. He's Chief Market Strategist at First Franklin Financial Services. FirstFranklinFS.com if you are looking for more information. And if you're looking for more of Money Life, well, we don't have too much time, but stick with us. We're going to cross the finish line together right after this message. So we've got just one or two things. We'll tell you what kind of day it's going to be and more. All the way to the end. Stick with us.
Hi, everybody. It's Rob Floyd, Money Life's executive producer. And this week we have a contest that covers two books that Chuck talked about with authors on the show. From Monday's show, it was The Almightier, How Money Became God, Greed Became Virtue, and Debt Became Sin by Paul Vigna. And on Tuesday's show, it was The Wealth Ladder, Proven Strategies for Every Step of Your Financial Life by Nick Majuli. For the contest, I combined the two books into one challenge and then tied it all to one of Chuck's favorite TV shows, South Park. Since the key elements of the book were a ladder and the Almighty, we're talking about what happened when Stan, Kyle, and Cartman built their infamous ladder to heaven. In that episode, the boys are trying to get to heaven to see their friend Kenny, who has died. Again, tell us what the boys are trying to get from Kenny that prompts them to build the ladder to heaven, to be entered for a chance to win the Almightier. And then tell us what they get if they find that item, to be entered for the Wealth Ladder. Send your answers and your name and address to chuck@moneylifeshow.com by 6 p.m. Eastern Time on Saturday, July 26th to enter. And please put the word contest in the subject line of your entry. Chuck will announce the winners on the July 28th show. Good luck, everybody.
So it's another week already.
Almost another month. I mean, we're through July at the end of next week. Hard to believe. Time flies when you're having fun, although I guess we're always proving that adage that days are long but years are short. I really don't understand where the time is going. But the good news is that as we get into new weeks, etc., we have new guests to talk about. And man, the lineup in August will be particularly impressive. But before we get to August, next week on this show, Frank Holmes, Chief Executive and Chief Investment Officer at U.S. Global Investors. Paul Gruenwald, Chief Economist at S&P Global Ratings. Scott Ladner, Chief Investment Officer at Horizon Investments. And I know if you're paying attention, Horizon Investments, well, they, of course, bought the Center Funds. James Abate was just here. We normally don't have guests from the same firm on that often, although that close together, though big interviews and market calls are different. But we had scheduled and then the deal came up and what have you. So we do have house rules about that sort of thing. In part, how often somebody can be back is because you get a guy like a James Abate or any of the folks we do the market call with, and their methodology doesn't change. So we want to let some market time go by so that you can then see whether or not things have changed and progressed. And then also, even with some of the big firms, while they have multiple experts, we want to have a little bit of time between one and the other. It helps us a little bit. But that's not all we've got coming next week. Patrick Healy, president at Caliber Financial Partners, will be back talking stocks. David Miller, co-founder of the Catalyst Mutual Funds, will be here next week. Love chatting with him. They do a lot of stuff that's insider trading related. And I hope I remember to ask him not so much about the astronomy thing, which astronomy not a public company, but the whole thing that wound up with the Coldplay thing. But I want to ask about when you see insider selling, if there was a scandal along those lines, what does it mean? And I hope I get a chance to remember that question. Also, by the way, next week, talking technicals, how about Matt Harris, Chief Investment Officer for the Hausberg Group, Hightower Advisors. He'll be back with us. Meanwhile, if you are looking for something to celebrate, well, one of my favorite days, it's National Get Gnarly Day.
Oh, gnarly!
Yeah, it's mostly one of my favorite days because we get to do that sounder from Sean Penn.
Oh, gnarly!
Yeah. Perhaps more importantly, it's National Hire a Veteran Day. It's National Merry-Go-Round Day or National Carousel Day. And it's funny, there's a beautiful carousel that years and years ago I was involved in helping to save in the next town over. And Gail and I drive past it all the time. We drove past it last Friday on our way out to a date night and said we need to go off and get on the carousel. So maybe we'll find time to do that this weekend. It's National Thread the Needle Day, National Talk in an Elevator Day, National System Administrator Appreciation Day. And it's funny, I don't have a system administrator realistically, my business too small, but Gail really relies on hers and she really does appreciate them. So, that makes me think, yeah, okay. And then on the food front, it's National Culinarians Day. Culinarians, basically your chefs and your cooks. Then it's a pretty fun day because it's National Hot Fudge Sundae Day. And it's also National Wine and Cheese Day. So you should be able to get behind all of that stuff. My guests today were Jason Akis. He's the head of healthcare investing for Aberdeen Investments, aberdeeninvestments.com. And they were ABRDN, Aberdeen, but they had dropped all the E's. So that's what I meant when I said they took their E's back. Brian O'Connor, personal finance journalist. He doesn't have a website specific to him, but we do have a version of that New York Times story that we discussed. And oh, by the way, it's a free version. It's a free share. So make sure you look in our show notes or where you find Brian on our guest page if you want to go read that piece in its entirety, whether you're a Times subscriber or not. And then Brett Ewing is chief market strategist at First Franklin Financial Services, firstfranklinfs.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Tim Tebow. You know who Tim Tebow is. And he said, when we talk about having a life of significance and meaning, it's not about fame or money or resources. It's about people and lives and hearts. Yeah. And while money's important, life is more important. So go out and do the things that help you improve your standing in people's lives and hearts this weekend. And spend time with the right people. Keep things in perspective. And remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great weekend, everybody. Stay safe and calm. We'll see you here on Money Life again on Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
This was just a complete disaster.